Welcome to Passive Pockets, formerly Passive Investing from Left Field. I'm your host, Jim Pfeifer. If you haven't heard yet, Left Field Investors merged with Bigger Pockets to become Passive Pockets. We are thrilled about the next chapter for our community. I wanted to give you all a little bit more information about what Passive Pockets is. Passive Pockets is your go-to site and community for learning how to build long-term wealth through passive real estate investing. Whether you're learning the fundamentals, strengthening your due diligence, or connecting with like-minded investors in the community, Passive Pockets has got you covered. This podcast is part of the free content that Passive Pockets has to offer. But check us out on the website because there's so much more. Visit us at www.passivepockets.com. Before we get into the episode today, I'd like to do a little bit of housekeeping. Formerly, the podcast was released every Sunday morning. Going forward, Passive Pockets is going to release every Tuesday. The first 5 episodes are going to be more back to basics because we're going to have a lot of new listeners. But don't worry, after that, we're going to get back to interviewing investors and operators and learning about their investing journeys. For all of our new members, I want a chance to introduce myself. I'm Jim Pfeifer, and I'm the founder of Left Field Investors. I started this community because previously I was an active investor. I was an accidental landlord. In 2008, we built a new house for a growing family, and we couldn't sell our property. So we had to put a tenant in there, and I did not like managing the tenant, but I really did like the financial aspects of it, seeing money come in, rent, cash flow. It was fantastic. So I soon caught the bug. I found Bigger Pockets and I started investing actively. I bought a few single family homes, some turnkey properties, and then I jumped up to multifamily and I bought a 22-unit multifamily property. And I bought a few other multifamily properties along the way. The problem was I was not a good asset manager. I was constantly fighting with the property manager. I didn't like dealing with tenants, but I liked the cash flow. I liked the appreciation. And so slowly, I kept investing in real estate, and then I found something called real estate syndications, and this changed everything. No longer did I have to be active. No longer did I have to manage a property manager. Now I can hire an asset manager. They go out and buy the property. They manage the property, and they just send me the cash flow. And at the end, I get some appreciation, and that's the investing I like to do. The problem was switching from active to passive. It's complicated because you don't know how to vet an operator or analyze a deal. So what did I need? I needed a community. I needed help from others. And so I started a small dinner club that turned into a 2,000-member community called Left Field Investors. And through Left Field Investors, we help educate people, get new people into passive investing and educate. We give tools. We had a podcast, and soon we grew big enough that we needed more resources. And we were fortunate enough to partner with a fantastic company, Bigger Pockets, and that turned into Passive Pockets, and that's where we are now. And we were thrilled because I strongly believe that investing in real estate is one of the best ways to become financially free. And if you're going to do it passively, I believe the number one most important factor to becoming a successful passive investor in real estate syndications is a community. You need to work together, learn from others, vet sponsors together, learn from others' experience, learn from others' mistakes. It's the best way to become successful in passively investing in real estate. Join a community, join Passive Pockets. On today's show, we're bringing on Kathy Fettke, an experienced and seasoned passive real estate investor. Today, we're going to focus on the basics of passive investing. We're going to cover what passive investing is, what a syndication is, who should be investing passively in real estate, and the benefits of investing passively versus active real estate investing. Enough about me. Let's get Kathy on here to talk passive investing. Kathy, welcome to Passive Pockets. Thanks for coming on the show.
Oh my gosh, I am so honored to be here.
Well, we're glad to have you. And today we are going to be talking Passive Investing 101. So the first question I'd like to ask is, can you help us define the different types of passive investing?
I think there's so much confusion about this. One thing I can tell you is not passive is flipping, fixing houses, wholesaling, being a real estate agent. These are all active real estate activities. It's basically a job. So active being something you're working in, you're getting your hands dirty, maybe you're not, you're actively involved. Passive would be more like buy and hold investing, where you buy a property and you collect rents on that. Depending on how much work that property needs, if it's an older property, it will be less passive. But say a triple net lease property, that's a commercial property where the tenant might be a a supermarket or, some kind of business, and the triple net means that they kind of just take care of everything and all you do is collect rents. So within buy and hold, there's different ways to be passive. The difference being someone else is doing the work for you for the most part. So to me, that's how I define it. Are you active? Is it a job, or are you investing in something more for the long term?
And can you maybe talk a little bit about there's different types or different degrees of passive, I guess. Originally I started out with single family turnkeys. I know you're very familiar with those. And I was pretty confident that was passive. But I spent most of my time arguing with property managers and trying to get them to manage it the way I wanted it to be managed, even though they knew more than I did. And that's different from syndication passive investing, which is what we're going to talk about. So can you talk about maybe the difference between those as well, and kind of as you go from less passive to more passive?
Yeah, in real estate, probably the most passive would be syndication. And that's basically, for those who don't know what that is, it's a group investment where you've got limited partners. Those are generally the investors. They're limited. They have limited liability, but they also have limited control and sometimes voting rights, sometimes not. Then you have the people who run that project. They're called the GPs, the general partners, who are in charge of making those big decisions and coming up with a business plan and pulling it off and, just basically managing the whole thing. So to invest in a syndication, you're really just handing your money over. Probably couldn't be more passive than that. I mean, your work, your active work should really be before you invest in it. That's all the due diligence and all the overview of what you're investing in. And then after that, you just got to hold on for the ride.
We're going to talk a lot about that a little bit later. And one of the things I wanted to mention is, people think of passive investing as also the stock market and things like that. So I just want to kind of talk a little bit about traditional. What we look at as traditional is, the stock market, where it's easy, everyone does it. The returns aren't that great and the tax situation is very bad. And then alternatives, which is what we're going to talk about, real estate syndications, the returns are great. You get better tax treatment, but it's hard. It's scary because you have to wire $25,000 or $50,000 to someone you might not know that well. And a lot of the investments are hidden. They can't advertise or they don't advertise. And so what we try to do is we call it community investing, community alternative investing, which is where you take your community and have them help you vet operators, look at deals, and it makes the alternative world a lot less scary. And so that's what we want to talk about today. And we've talked a little bit about this, but the difference between active real estate and passive, why would an investor choose passive real estate investing?
So many reasons. This is why I really like to draw that line. So many times people think that flipping houses is real estate investing, and that's the only thing to do, or that's what you should do. Recently, it's been flipping apartments. That was a big deal that so many people were jumping into. But what if you're already busy? What if you are a doctor or a dentist? You spend 10 years in your learning your trade and you're doing pretty well, have a good business. You shouldn't be out there trying to flip properties, If you're, say, a professional athlete, or I live in California, a lot of people in the tech industry, they work 80-hour weeks. How are they going to flip houses? How are they even going to take time to eat and see their family and so forth? So if you already have a job and you're busy, so you have more money than time, then passive investing is probably for you. If you have more time than money, then you probably need to be a little more active.
I love that explanation because everyone wants to get to financial freedom, but you have to figure out how do you want to get there. I also look at it as if you don't have a skill or knowledge in a market, like you can't swing a hammer or you aren't, really into the Phoenix market and you just have general knowledge, then passive investing might be a great place for you as well because you don't have the skills maybe to get an advantage, but you have maybe capital and you have enough skill to maybe vet the operators. So I think there's a lot of different ways you can decide if you want to be a passive type investor. We do have to take a quick break to hear a word from our sponsors, but more from Kathy Fettke when we return. Welcome back to Passive Pockets. Let's jump back in. So when we're talking about passive investing in real estate syndications, what are some of the benefits?
Well, you just said it. You're partnering with someone who hopefully knows what they're doing and they're going to do it for you. So what's better than that? But too often that's not the case. It's many people recently have syndicated with operators who were pretty new to the business. Maybe they did one or two good deals because the market carried them. It's been strong. And then that came to a stop. Being able to find the right partners and invest with them can be a reason to syndicate, because you don't have the knowledge to do it yourself. You don't have the time to do it yourself. Let someone else do it.
I think we have a lot of listeners who might be active real estate investors. So a lot of the benefits are similar. Can you talk about the tax benefits and some of the other just general real estate benefits that you still get when you are investing in the syndication?
It's such a good question, and every syndication is different. What you get when you invest in a syndication, it's regulated by the Securities Exchange Commission, so it's different than a straight real estate deal. It kind of falls under securities. So there's a lot of regulation there, and one of the things that's required is a PPM, that's a private placement memorandum. And also with that comes an operating agreement for the LLC. It's usually held in an LLC, limited liability company, which means if you're a high net worth dentist or doctor and you put $50,000 in a deal and it doesn't go well and there's a lawsuit, it's not going to come after you and your personal finances. It's going to go after anything within that LLC. Everything outside is protected. So usually these kinds of things are in an LLC with that operating agreement explaining how it works, how the money comes in, how it flows back out once profits are there. And everyone is kind of different. So you really need to understand what those tax implications are. This is what we've seen time and time again of people not knowing that they're equity investors. So they're going to have a different tax treatment than maybe if they had come in as a lender. It can be different for everyone. But with that said, to answer your specific question, let's say our build to rent fund. We're buying land, we're building homes, we're holding it to rent. That's the same tax treatment you'd get if you just went out and bought a rental property. The difference is, we're doing it for you. So we do all the work. You still get the tax treatment that you would get if you own that rental, which would be depreciation, in some cases accelerated depreciation, bonus depreciation, all things that people love when it comes to reducing their taxes flows through the LLC.
That's awesome. So you get the same benefits of active real estate investing in a passive investment, which I think, that means that you can hire experts. You just mentioned make sure your CPA reviews the documents. Well, you also have an experienced asset manager that manages the property for you, so you don't have to do that. So you're effectively hiring a professional, just like you would your taxes, just like you would when you want your legal documents done. You hire a professional to manage the real estate, and you effectively get the returns of an active real estate investor, but you don't have to, as you said, do all the work. You just get to ride on somebody else's coattails.
Yeah, but again, just depending on how your financial situation is, how much money you make, your tax treatment's going to be different than, other people within the deal. It flows through. But you also have to really understand what the PPM says, because maybe an operator says, you know what, I want these tax benefits. I'm not going to pass it on to the investors. That could be written in the documents, usually isn't, but could be. So you need to know, you need to be able to read these very high-level documents and understand how it's going to affect you. And again, it's not easy to do. Get a professional to help you.
I couldn't agree more. And I would also recommend that you join a community like Passive Pockets,
yes,
because that's where you can learn from other people's mistakes, where maybe someone didn't read the PPM and they missed something. Well, for sure that person is going to be talking constantly about, hey, make sure you do this. So that's the best way I've found to learn from other people's mistakes, is by joining a community of people who've already done this.
I wish there were more communities that before today. And I love that Bigger Pockets is doing this and focusing on passive investing. A lot of people are attracted to real estate because they think of the active side of it. But again, there's a lot of people who just shouldn't be active. You just don't have the time or the knowledge to do it. So, why burden yourself? I've seen that go bad so many times. My brother-in-law saying, hey, the house for sale next door is for sale. I'm going to buy it and renovate it. And 2 years later, he's lost everything. So this isn't like weekend warrior stuff, It's an investment and you've got to know what you're doing.
Yes, absolutely. And so I want to talk a little bit about, we mentioned it, but who is this really for? We talked about, high net worth people maybe that have jobs, they're working 80 hours a week and they don't have time. It could also be for people who are active investors who want to maybe transition a little bit and not do as much active and be a little bit more passive. So can we talk about what kind of capital do you need to start investing?
Well, let's start with who can invest. And we don't have a choice about that. That is the Securities Exchange Commission who decides who's eligible to invest in a syndication. And that is generally an accredited investor. Accredited sounds like you had to go to school at some university and get some kind of degree. Nope, you don't have to actually know a thing. You just have to have a certain amount of money. The SEC defines accredited as either earning $200,000 if you're an individual or $300,000 as a married couple. That's one way to qualify. Or you have $1 million net worth excluding your home equity in your primary residence, or you have certain securities licenses. So you can look that up, search SEC accredited investor to know if you qualify. There are some situations where you can file with the SEC as a 506B offering, and that allows 35 non-accredited investors. But still, you have to be a sophisticated investor. You have to prove that you understand this investment. And basically, my attorney said you should never invest more than 10% of your net worth in any one project. They don't want to see somebody who's got $50,000 total put $50,000 in a deal and lose everything that they worked for. So there's really no clear definition of what is a non-accredited sophisticated investor is, but my attorney said someone between a $350,000 to $500,000 net worth would be okay, and they really shouldn't invest more than 10% of that into any one deal.
Yeah, and I think that's great advice. And I think sometimes, all the focus goes on the accredited investor because that's what you really want as an operator. But I would also say when we had left field investors, we probably had 20% of our community were non-accredited. And those were sometimes the most active people because they really had to work hard to find investment. So I would agree that you want to make sure that you have capital. And great advice, don't invest more than 10% in any one deal. But if you're kind of on the cusp and not quite accredited yet, that doesn't mean there aren't opportunities for you as an investor. It just means you're going to have to work a little harder. Is that correct?
I don't like it when people come to me and say, I finally saved $50,000. Now I can invest in your syndication.
Right.
We say, no, you're not ready. Take that $50,000 and invest it in a different kind of investment that isn't as, risky. It's not putting all your eggs in one basket. For example, I would probably have somebody buy, a turnkey rental, like we said, or continue to build that equity to get to a point where then you've got $500,000 net worth and investing $50,000 isn't going to kill you, isn't going to ruin you. Yeah, generally, until you're a sophisticated investor, you are going to be more active. You are going to be more active to build that nest egg, which is why when you're being an active investor, trying to get to that passive income place, I feel like too many people focus on the cash flow too soon because what you're really trying to do is build wealth. You're trying to build wealth. And the last thing I want to see somebody do is buy a buy and hold as they're in this wealth building phase of their life. And that property is worth the same in 20 years as when you paid for it. And that happens. Like there's some cash flow markets in this country where values just never go up. Well, that's never going to get you where you want to be. So in the beginning, when you're building and you're trying to build that passive income for the future, you really want to be focusing on building that equity.
Staying on the topic of who's passive investing for, do you have to have a deep knowledge in real estate to invest passively? Is it different if you're active or passive? Or if you don't have that education, let's say you're accredited and you have the assets, how comfortable with the real estate should you be before investing? And is it different from how comfortable you should be with active real estate?
I think so, but you can have someone help you. I've worked with really high net worth people who have an advisor that's protecting them and that knows that has invested in real estate and can review the documents and the business plan. Over the past 4 years, it's been really heartbreaking watching people lose a lot of money because they jumped into things that they didn't really understand and put far too much money. The number one rule of investing is never put too much in any one deal. You want to diversify. I was at a real estate event where I met a doctor who put $1 million into a deal. She brought all her doctor friends and they all did too. And I was sitting next to a lender. I got the name of the property and I asked the lender, how's that property doing? And he's like, they're going to lose everything. So, it just is heartbreaking because here this doctor thought, how long did it take her to make $1 million and then just lose it in a year? And then all her friends too, like the burden of that. Awful. And so had I had the opportunity to speak with them, I would say, put 50,000 in. There's like 20 different operators. You could, spread it out. If you're going to do $1 million gamble, you sure better know what you're doing. Yes, you do need to understand it.
I think diversification is one of the most important things you can do in passive real estate investing. And in fact, I think it's probably more important than in active, because in passive real estate, at Passive Pockets, we recommend you diversify by operator. So you're in multiple deals, as you mentioned, there's a bunch of operators. So don't put all your money with one operator. And then also different asset classes. You said you're doing build to rent. Well, there's apartments, there's self-storage, there's mobile home parks, there's car washes. I mean, I could go on and on. There's a bunch of different asset classes. So get in all of those. And then you also buy market, right? You don't want to just be in Phoenix or just be in Dallas. Try to get in different markets and not just, I think in the last 5 years, everybody was in the same, few Sunbelt markets. Well, you could also get something in the Midwest and some other places. So I think diversification is important. How do you feel about diversification in syndications or passive investing as opposed to active?
If you're going to invest your hard-earned money, and I see this again over and over again, where somehow people don't value this money that they've worked so hard and they just throw it. They just throw it at the wall and hope that it sticks. If you're investing with a syndicator who's done car washes for 20 years and they know how to operate it and they know what they're doing, wonderful. Invest with them. But if you find someone who just discovered that car washes are a good idea, absolutely not. Don't be their test monkey. Let them test it on their own money, on their own time. And once they've got years and years of experience, then do it. Or make sure they have somebody on their team that's done it before. There's a difference also with active syndications that are businesses versus more passive syndications. So a car wash is a business. You're basically investing in someone's business versus an apartment that is a little bit more of passive activity once you've done all the renovations and so forth. So again, is that what you want? And how will that be treated tax-wise? We build homes. We buy land. We buy subdivisions. We buy project from builders that are failing, and we finish those projects out in a syndication. We raise money to do all that, and then we sell those homes. Now, when we sell those homes, like a builder sells to the public, guess what? It's a business, which means that it's a very different tax treatment than our build to rent, where we're doing the same thing. We're buying the land, we're building houses, but we're holding it. And so the tax treatment's going to be different. That's important to understand too, which asset class is going to be a little more active. And if it's super active, boy, that team better know what they're doing, because you're really buying into a business versus an apartment. Still, they better know what they're doing because there's a lot involved in managing an apartment, but again, a little bit more passive.
And I think that advice of, if someone's just discovered car washes and they're a self-storage operator and like, oh, we're doing car washes now, that is some of the best advice, because they might be your favorite self-storage operator. They might have made you a ton of money in self-storage. They don't know anything about car washes. They just heard it from a buddy and they're like, well, let's give that a try. I don't want to be your guinea pig. Prove it and make some money and then call me in a couple of deals. So that's just fantastic advice. I love that. We have to take a final break, but you won't want to miss what Kathy has to say about passive investing next. Stay tuned. Welcome back to Passive Pockets. We talked a little bit about this, but a real estate syndication, it has LPs, which are limited partners, GPs, which are general partners. There's also, they call them operators, syndicators, deal providers. Can you talk a little bit about the difference between those terms, the operator and the investor, and then all the other terms they use for it?
If there's a deal and you're investing directly in that deal, then you're an LP in that. But if there's a fund that was formed to invest in that deal and you're in that fund, then you're an LP and the fund is an LP, limited partner. And I've done that a few times and it's tough. It's super tough because LPs, like I said, they don't have a lot of power. They don't sometimes have voting rights. They are just along for the ride. So important to distinguish, am I investing in the actual deal or in somebody who started a fund and is investing in someone else's deal? Yeah, so then there's the GP that is, I've looked at it several ways. The sponsor is really the one putting it together. They are bringing in all the pieces. They're bringing in the property management. They're bringing in the general contractor, pulling it all together, and the investors. An operator, I use both terms, but I think the operator is really the one doing the operations of it. And they can sometimes be separate, I think, but usually they're the same. And then the syndicator is also the sponsor. It's the team that is managing the project. Now, the GP, this general partner, this syndicator sponsor, they are liable. They are liable for what goes well or doesn't go well with the project. So the LPs, like I said, they're on the bus, right? But the sponsor is the bus driver. So if the bus driver is following the plan, here's the plan, here's the route, here's what we're doing, we told you ahead of time, here's where we're going, and they stick with that, but all of a sudden a bridge collapses on their way to wherever they were going and it's not their fault, they're not really going to be liable. Let's say, I don't know, a recession or something that they couldn't have predicted. Something happens and they can't get to the destination. They can't finish the project the way they wanted to. Well, you're not going to be able to sue them for that. But if they totally veer off, they just take a back road and do something that wasn't the business plan, that wasn't what you agreed to. You signed on a deal. You gave them money in exchange for them following the business plan that they gave you. And I can't tell you how many times the driver goes off the path, and spends more than is said, than is, you should have a budget. It should be very, very clear what we're doing together, where we're on this bus together. Where are we going? How long is it going to take? How much is it going to cost? Do you get lunch breaks? What I mean by that, literally, when we looked over the documents in one deal I was in, we saw that we were paying for a private jet. Really? Was this in the original business plan? Because I don't remember agreeing to that. But if it's vague and it's not really spelled out, then yeah, those drivers could drive you wherever they want to. So make sure before you get on that bus, before you sign on the deal, you know exactly what the business plan is, so you know exactly if they veered from it.
That's great stuff. So you're going to have to look at the documents. You're also going to vet the operator, which we'll talk about in a minute. I want to talk a little bit about return profiles. So when you're investing in these deals, how do you get paid? Are you paid distributions monthly or quarterly? Then there's appreciation at the back end. Can you kind of just talk about how an investor can expect to be paid? Because that's a pretty important part of this thing, right? If you're not getting paid, what are you doing?
So yes, and yes, all of that. You get paid however the documents say you're going to get paid. So make sure you understand the documents. I've had people in my syndications, most people have a preferred return, and I'll explain that term. You put $50,000 in a deal. They say there's a 6% preferred return and then an 80-20 split afterwards. So what in the world does all that mean? Well, again, and you have to read that section. If there's any section to read in the PPM, it's that. It's the distribution. How do I get my money back? How do I get my return? And when? Normally, at least in our documents, it would be capital back first, then preferred return, and then a split after that. As the money comes in, you're getting your $50,000 back. And then per year that your money was tied up, you get that preferred return is usually annual, but make sure you read it. Is it compounded? Is it not? Is it annualized? What do the documents say? Sometimes I'll see it's an ROI. Well, if it's just like a flat return on investment, but doesn't say how many years it's going to take, let's say you're going to get a 20% return, but it's over 5 years. How much are you really getting? The payout is however it's described. And I've seen all kinds of weird things. I've seen crazy stuff that's like, well, this isn't clear and this isn't defined. And how are you really going to get your money? And who's getting it before you? What debt maybe has priority to you? Is there a loan? Is there another loan? Is there a bridge loan? Can the sponsors take out another loan if more money's needed, and that takes priority to you getting paid? So that really has to be spelled out too. Who could possibly take priority to me getting my capital back in my preferred?
It's very important to understand that, right? Because it also changes whether it's a cash flow now kind of deal where maybe it's apartments that don't have a lot of repairs to be done. So maybe they can pay cash flow out every month, or build to rent. Again, going back to what you do, you're probably not going to be paying out much in the first year or two as that is being built, but then there's a lot of appreciation on the back end. So you really have to understand, are you investing for cash flow or are you investing for appreciation? That's one of the important things, I think.
Absolutely. Absolutely. With our rental fund, we were buying properties that were, older. It took about 3 months to renovate them. So we could get them stabilized within 4 or 5 months. But with our build to rent, it's going to be a couple of years. So you better believe you're not going to get money back. If you were getting money back, where in the world is that coming from? Because this is something investors don't understand. They put their money in the deal and then they're like, where's my money? Why didn't I get my money back? Well, you know where your money is? It's in the land. We bought the land and then we had to buy materials and we had to build houses and pay for marketing and try to sell those houses or rent them. Your money is tied up. There is no way for you to get your money out before. So with a build to rent, the plan is 5 to 7 years with us stabilizing in about 2 to 3 years. And starting distributions then, and then selling after 5 years where you get all that upside.
Right. And that's something that you really need to understand, because if you're an investor who needs cash flow, then you probably need to invest in something that gives you cash flow sooner. And that's one of the mistakes I made when I started, is I wasn't really thinking. I was just getting excited about different investments, and I wasn't thinking the strategy had to match what my goals were. My goals were cash flow, but I saw some nice appreciation deals and invested in them, and then sat around wondering, where's my money, right?
Where's my money?
Which that was my mistake. So it's important to get that figured out before you invest. So I'd like to switch here a little bit and talk about some of the due diligence investing in real estate syndications. And from my perspective, the most important is making sure you're with a good operator. So can you talk about how do you vet the operator? What do you think the importance of vetting the operator is, and some of the things that you look for?
Yes, I have been doing this 15 years, and I can tell you all the things that can go wrong. There are certain traits that people have that are lovely, like optimism. Optimism's a terrible trait when it comes to real estate. An optimistic plan is just hopeful. So I would partner with people who maybe had experience, like you said earlier, in one thing. And then we get really excited about doing this new thing that seemed cool, but they didn't have the experience and we were far too optimistic. And things almost always take longer and cost more than you expect. So a good operator is going to have plenty of reserves set aside. They're going to be realistic in their timelines. They're going to have a list of past projects that they can show you, yeah, they hit those timelines and they hit those targets. And if they didn't, they explain why. So don't be afraid to ask for that resume and, what was your projections and how did things turn out in your past projects? They should be willing to share that. They also, in the documents, there should be like sort of a worst case and best case scenario. Too often people are like, this is the business plan, period. And then something goes wrong and they have no backup. They have no plan B, so there needs to be those questions like, well, what if this happened? As an investor, you ideally should be able to ask those questions, but a good operator would already have answered them in the PPM. They already would have all the questions you would ask spelled out. If things don't go this way, we've got this backup plan, and so forth and so forth. And like I said, a good operator will raise enough money to have plenty of reserves on hand such that if there are surprises, and there always are, there's money. Because the reason things don't go well is when you run out of money.
And so when you're vetting an operator, you get a chance to actually talk to them, right? It's different when you're, say, investing in Apple stock. You don't get to call up Tim Cook and ask him questions. But if I'm investing in your build to rent, I get to call you up and ask you questions. Are there some things that I should make sure to ask, or are there things maybe looked at a different way? If you aren't willing to answer, or you're a little cagey, should I keep pressing and ask those questions, or should I be careful in what I'm asking to the operator?
Transparency is everything. And I think it's great to ask really hard questions because then you can see what that person's made of. If they're defensive, get out. There's no reason to be defensive. Somebody's asking a good question. And it may be something that the operator hadn't thought of before. So absolutely, you should be able to ask questions. Since day one, I wanted to make sure, I think it was partly selfish. I didn't want to answer the same question a million times, but I also wanted investors to hear other investors' questions, because sometimes you don't know what to ask. So at Real Wealth, when I do any kind of presentation, I open it up to questions every time, and I fully expect there's going to be questions I can't answer. And if that happens, then it's like, I'm going to get right back to you on that. We're going to do another webinar next week, and I'm going to have the answer.
I'm sorry. I just think that's fantastic. The two things that you said there, you are an operator, and you're saying, LPs, limited partners, bring me your tough questions. And I think if you're an operator and you run away from that, that is so easy for an LP, right? Because my decision is done. I'm not investing with you.
You're done.
Yeah.
Exactly.
But if you're willing to take the tough questions, that's number one. And then number two, if you are willing to say, you know what, I don't know, but I'll get right back to you, and then you actually do it, that is so uncommon, because I think a lot of operators, they feel like they have to have all the answers, and so they're just going to say something, and it might not be right.
Oh, man. Yeah, don't do that.
Right. So when you are looking for an operator, when you're vetting an operator, ask the tough questions, and if they don't know and they're going to go back, that's a great way to check their communication, right? If you promise me that you're going to go back and get that answer, and then you don't, Well, that tells me something, right? And what you're trying to do when you're vetting an operator is get the measure of the person. See if you want to spend the next 3, 5, 7, 10 years partnering with them, because that's what you're doing. So that's a great answer. I love that. I want to talk real quick about the deal. I think the operator is the most important part because you're giving them your money and they're going to operate this. You want to make sure they're doing it in a quality way. So once I've vetted the operator and I've said, okay, this is the person that I want to invest with, what do I do when the deal comes? How do I evaluate that?
Again, it depends on how complicated the deal is. And I've heard some people say, if you can't explain it to grandma, then you probably shouldn't do it. And I have done very, very complicated deals and shouldn't have done them. So if the business plan is simple enough for anyone to understand, that's great. That's a good start. But from there, if you're working with an operator, let's say Ken McElroy, for example, he's been doing it for 30 years and has an incredibly successful track record, and he's going to do another deal and it's similar to all the other ones. Maybe you can be a little less concerned. Someone like that is not going to want to tarnish their reputation after 30 years of awesomeness. But if it's someone fairly new and you're willing to take a bet on that person, knowing they're new, but they're dynamic and they seem smart and they've had a few good deals under their belt, this is the active part of being a passive investor. The better you understand the deal, the better your chances of success. The more energy you can put on the front end, analyzing and learning and there's underwriters are everywhere, especially today. There's a lot of them out of work now. So find a good underwriter to look at the deal with you and analyze it. We have some professional investors in our network that's all they do. They just invest their money and they're good at it. They're good at it because they understand it, or they have advisors who help them understand the deals. You can go in blindly, and most of us are kind of trained to do that with the stock market. How could we possibly, I missed out on NVIDIA, but I didn't understand it. How could I possibly have known that was going to rocket like it did? Maybe somebody in that industry could see it. And so had I had a friend in tech, maybe I would have been able to see it too. Either know someone who's very good at it and is willing that you could pay them. You go to buy a new house and you pay someone $450, $500 to do an inspection. Do it on this. It's your money. It's your money. It's worth it.
Yeah, and that's why you join a community like Passive Pockets, right? You pay a few bucks and you get a whole group of people that are passionate about what you're passionate about. And the thing I really like that you said there was we're talking about passive investing, right? And what you said is be an active passive investor. You got to be active before you send the wire, because after you send that wire, it's out of your control. You cannot do a thing after that but sit back, like I said, hopefully collect money and reports, right? But before that, that's when you're active. You are actively vetting the operator, actively analyzing the deal, actively using the people in your community to help you so you can learn from them. And that's the best way to go out. So Kathy, any last words, recommendations for new passive or actively passive investors in real estate syndications?
I'm just so excited that we're talking about this. This has been my thing forever. I think there's been a little bit of a looking down your nose at people who are passive, because it is so sexy to be a flipper or a wholesaler. And I'm not that. That's not my skill set. I never really even wanted to do that. But investing passively is my jam. I love it. So I'm glad we're giving attention to this. I know there's other people out there who have careers they love. They're making a ton of money. They're inheriting money. You've got trillions of dollars that's going to be passed to the younger generation. So the timing is perfect for people to understand how to invest more passively.
Kathy, thank you so much for appearing on the first episode of Passive Pockets. We really appreciate the content you gave to our audience. To the listeners, thanks for showing up, and we'll see you next time. If you'd like to learn more about Passive Pockets, check us out at www.passivepockets.com.